Hey everyone, and welcome back to the channel. Today, we're diving deep into a question that's on every Bitcoin holder's mind. How can I make my Bitcoin work for me? For years, the mantra was simple. HODL, buy it, store it, and wait. But the crypto space has evolved. Now, it's all about yield. We've seen an explosion of strategies to earn returns on your assets, and Bitcoin is no exception. This brings us to a fascinating new player in the game, Lombard and its liquid staking token, LBTC. The project claims to offer a superior way to hold and utilize your Bitcoin. But is it really the best way? In this video, we're going to break it all down. We'll analyze what Lombard is, how it works, the yield opportunities it presents, and critically, the risks involved. We'll even compare it to traditional holding and other wrapped Bitcoin solutions. By the end of this, you'll have a clear picture of whether LBTC is the right move for your portfolio. So, if you're serious about maximizing your Bitcoin's potential, you're in the right place. Let's get into it. So, what exactly is Lombard? And what is this LBTC token we keep hearing about? At its core, Lombard is a protocol designed to unlock the liquidity of staked assets, starting with Bitcoin. Think of it as a bridge that allows your securely held Bitcoin to participate in the decentralized finance, or DeFi, ecosystem without ever leaving the security of the Bitcoin network. The star of the show is LBTC, which stands for Lombard Bitcoin. It's a liquid staking token that represents your staked Bitcoin on a one-to-one basis. When you deposit your Bitcoin through the Lombard Protocol, you receive an equivalent amount of LBTC in return. This LBTC is a fully fledged ERC20 token, meaning it can be used across various DeFi applications on Ethereum and other compatible chains. The idea is to solve a major problem for Bitcoin holders, the opportunity cost of just holding. While your Bitcoin sits in a wallet, it's not generating any yield. Lombard aims to change that by giving you a liquid, yield-bearing version of your BTC, allowing you to have your cake and eat it to maintaining your Bitcoin exposure while simultaneously earning rewards in the DeFi world. It's a powerful concept, but the magic is really in the execution and the technology that underpins it. Let's unpack how this whole system actually works, because security is paramount when we're talking about Bitcoin. The process starts when you, the user, decide to mint LBTC. You send your Bitcoin to a secure, decentralized vault managed by the Lombard Protocol. This is where a key piece of technology comes into play: Babylon. Babylon is a revolutionary protocol that brings Bitcoin security to other blockchains. Lombard leverages Babylon's Bitcoin staking protocol, which means the security of your deposited Bitcoin is anchored directly to the Bitcoin network itself. Instead of relying on a centralized custodian or a multi-sig wallet controlled by a small group, Lombard uses a network of decentralized validators who are economically incentivized to act honestly. Once your Bitcoin deposit is confirmed on the Bitcoin blockchain, the Lombard smart contract on the Ethereum network is triggered to mint the corresponding amount of LBTC and send it to your wallet. This process is designed to be trustless and non-custodial. To redeem your Bitcoin, you simply do the reverse. You send your LBTC back to the protocol's smart contract, which burns the LBTC and initiates the process to unlock and return your original Bitcoin from the decentralized vault. This elegant integration of Bitcoin's native security through Babylon is what sets Lombard apart from many other wrapped Bitcoin solutions that often rely on more centralized or less secure bridging mechanisms. It's a sophisticated approach aimed at providing peace of mind. All right, now for the part you've all been waiting for. How can you actually make money with LBTC? This is where the true power of liquid staking shines. Once you have LBTC in your wallet, a whole universe of DeFi yield opportunities opens up. The most straightforward way to earn is by providing liquidity. You can pair your LBTC with other assets like ETH or a stablecoin in a liquidity pool on a decentralized exchange like Uniswap or Curve. By doing this, you'll earn a share of the trading fees generated by that pool, and often additional rewards in the form of the platform's native token. Another popular strategy is lending. You can deposit your LBTC into a lending protocol like AV or Compound. Other users can then borrow your LBTC, and you earn interest on it. This is a relatively lower risk way to generate a steady, passive income stream. For those with a higher risk appetite, there's yield farming. This often involves more complex strategies, like staking your liquidity pool tokens in a farm to earn even more rewards. Many protocols will specifically incentivize LBTC pools to attract liquidity, offering very attractive annual percentage yields, or APYs. The beauty of LBTC is its composability. You could, for example, use your LBTC as collateral to borrow a stablecoin, then use that stablecoin to farm yield somewhere else. This is known as looping or leveraged yield farming, and while it can amplify your returns, it also significantly amplifies your risk. The key is that LBTC transforms your static Bitcoin into a dynamic, productive asset that you can deploy across the DeFi landscape to find the best possible returns that match your personal risk tolerance. Of course, no discussion of high yield would be complete without a serious assessment of the risks. Nothing in DeFi is risk-free, and it's crucial to understand what you're getting to with Lombard and LBTC. The first and most obvious is smart contract risk. Lombard, like any DeFi protocol, is built on complex smart contracts. While these are typically audited by security firms, there's always a non-zero chance of a bug or vulnerability that could be exploited by a malicious actor, potentially leading to a loss of funds. Second, there's the risk associated with the underlying technology, specifically Babylon. While Babylon aims to bring Bitcoin-level security, it's still a relatively new and complex system. Any unforeseen issues in its implementation could impact the security of the staked Bitcoin. Then we have market risks. The value of your LBTC is pegged to Bitcoin, so you're still exposed to Bitcoin's price volatility. Furthermore, if you're providing liquidity, you need to be aware of impermanent loss, which can occur when the price of the assets in a liquidity pool diverges. Finally, there's a degree of centralization risk to consider. While the protocol aims for decentralization, we need to look at who controls the smart contract upgrades and governance. Is it a DAO with widespread token distribution, or is it a small team of developers? Early on, most projects have a more centralized team, which introduces a vector of risk. It's essential to weigh these potential risks against the potential rewards before committing your capital. Always do your own research and never invest more than you can afford to lose. So how does holding LBTC stack up against the alternatives? Let's compare it. First, versus traditional HO dealing. The classic buy and hold strategy is the simplest and in some ways, the most secure. Your Bitcoin sits in your cold wallet, and you're not exposed to smart contract or the complexities of DeFi. The downside? Zero yield. Your asset is completely idle. By using LBTC, you sacrifice some of that simplicity and introduce new risks, but in exchange, you gain the ability to earn a potentially significant yield. It's a trade-off between absolute security and capital efficiency. Now, let's compare LBTC to other wrapped Bitcoin solutions, like WBTC or RenBTC. The biggest differentiator for LBTC is its security model. Many wrapped tokens rely on a centralized custodian. For example, with WBTC, you're trusting BitGo to hold the underlying Bitcoin. This introduces a single point of failure and counterparty risk. LBTC, by leveraging Babylon's decentralized staking protocol, aims to be far more trustless and aligned with the core ethos of decentralization. It secures the peg through cryptographic and economic incentives on the Bitcoin network itself, rather than through trust in a single company. This non-custodial approach is a major selling point for DeFi purists and anyone wary of centralized points of failure. While other wrapped tokens have a longer track record and more liquidity right now, LBTC's security architecture presents a compelling argument for it being a next-generation solution for bringing Bitcoin into the DeFi ecosystem. We've covered a lot of ground, so let's bring it all together. Is Lombard and LBTC the absolute best way to hold Bitcoin? The answer, as is often the case in crypto, is It depends on you. It depends on your goals, your risk tolerance, and your level of technical expertise. If your top priority is simplicity and maximum security above all else, and you're not concerned with generating yield, then traditional HO dealing in a hardware wallet remains the gold standard. However, if you're a Bitcoin holder who looks at the vibrant DeFi ecosystem and wants to participate, if you want your assets to be productive instead of idle, then LBTC presents an incredibly compelling option. It offers a pathway to earn yield through lending, liquidity providing, and farming, all while maintaining your core exposure to Bitcoin's price action. What truly makes Lombard stand out is its commitment to decentralization and security through its integration with Babylon. This trustless, non-custodial model is a significant step up from many first-generation wrapped Bitcoin solutions that rely on centralized custodians. So it may not be the best way for everyone, but for the savvy crypto enthusiasts looking to maximize capital efficiency without handing their keys over to a centralized entity, LBTC is undoubtedly one of the most innovative and promising solutions to emerge. It represents the evolution of hodling a move from passive storage to active participation. As always, the space is moving fast, but Lombard is definitely a project to watch closely. Thank you so much for joining me for this deep dive into Lombard and LBTC. I hope this breakdown gave you a clear understanding of the protocol, its potential, and the risks involved. If you found this video helpful and informative, please hit that like button. It really helps the channel out. And for more in-depth analysis on the latest in crypto and DeFi, make sure you're subscribed and have those notifications turned on so you don't miss a thing. I'd love to hear your thoughts in the comments below. Are you bullish on liquid Bitcoin staking? What are your favorite ways to earn yield on your BTC? Let's get the conversation started. Stay safe, stay informed, and I'll see you in the next video.